Hey everybody, welcome to Chapter 9, our discussion on plant assets, which are also commonly referred to as fixed assets and also referred to as property, plant, and equipment, or PP&E. So let's start our discussion. Here we go. We are going to start with some definitions like we always do at the beginning of the chapter. So what is property, plant, and equipment? These are the assets that fall under long-term assets that we plan to keep at least a year and that will help us run our business. Okay, they are meant for operations. Some of them include or accounts such as land, buildings, equipment, furniture, fixtures, automobiles, computers and technology. Those are all types of property, plant, and equipment. We're going to help them to make our product. All right. If we had land we bought, let's say that we're going to hold it a year because we think in 1 year a developer is going to come by and buy it and we'll make money off of it, then that is not land held for operations. That is land held for an investment. That would not be considered property, plant, and equipment. That would be included under long-term investments. So that's just a little extra something to keep in the back of your mind. So we know they're long-term, and the one thing we were somewhat introduced to earlier in the course is depreciation. We spoke about accumulated depreciation, and in one of our chapters we saw a very easy straight line depreciation calculation done. Depreciation is calculated on all of our property, plant, and equipment, those long-term assets. It is calculated so that we can find a portion of the asset that has lost its usefulness in that fiscal year. If you think about it, if I buy a 10-year piece of equipment, or that's supposed to last 10 years, and I buy it in year 1, it works really well. Well, what about by year 4, 5, 6, 7? Every year it gets older, and it's been in use, and it may not work the same as it did in year 1. So that loss of usefulness has to be captured, and we're going to capture that in depreciation. Depreciation is a gap principle because it helps us to follow the matching principle. So I am, in the year that machinery helps me, let's say I'm Hershey's and I'm pumping out those chocolate bars, in the year that I sell those chocolate bars, I've made them and I sell them, the work that machine has done in that year, I have to capture the corresponding expense. And for that machine, it would be depreciation. Okay, so I am matching the revenue earned in a year with the corresponding expenses that have been incurred to help earn that revenue. That's our matching principle. All right. In this chapter, we're going to look at 3 phases of an asset. We're going to look at purchasing the asset, then what happens when we use the asset, how do we account for the usage, and how do we account for the disposal of the asset. All right. We have already discussed the cost principle, that we know that we're going to pay or record the asset at the price purchase the asset for. We're not going to record it at the fair market value. We're not going to record it at the original price. We're going to record it at the actual price we paid. Keep in mind that price will include anything we have to pay to acquire the asset. So we may buy a machine for $5,000, but in addition to the purchase price of the machine, I may have to pay shipping of $700. I may have to pay an installation fee. Engineers may have to come and make sure I have enough, my circuits can handle the electricity, the power being brought to this machine. So all the price of all those things. I may pay a commission to a salesperson who helped me find the machine. Everything added together is the cost of that machine. And we will see more about that. Okay, so let's look at some of our categories. Land and land improvements. First thing is those are 2 different property, plant, and equipment accounts. Land is one, and land improvements is another. Okay, if you look at this bullet, land, if I buy land, I pay a purchase price. I also may pay a commission to a broker, right, or a real estate agent. I may have to have that property surveyed and pay lawyers to handle the sale, to make sure I will have title, things like that. Any property taxes the previous owner didn't pay, if I'm responsible for them. All of these costs I add up, and that's the price I put on my accounting records. That's the price I'm going to debit land for. Just take one quick look here. Cost of clearing the land. So if I buy a lot of land and on it is an old barn and an old tractor, and I want to make a parking lot out of it, or I want to build a manufacturing facility on it, I have to get rid of all those items. So it will cost me money to tear down that old barn or to remove that big tractor. Those costs are also included in the price of the land. So then what are land improvements? These are land improvements. These are things that you put on the land that won't last forever. Unlike land, right? Land's not going anywhere. Land improvement, the items will eventually need to be fixed and replaced. And those include things like fencing, paving, signs, lighting, sprinkler systems, landscaping. Those are all land improvements. All right. One quick thing I didn't say, land is the only fixed asset that we do not depreciate. There is no expense associated with it because our assumption is land will always be there and there is no loss in value. Okay. Land improvements, however, do lose value over the years. The fencing, the paving, the sprinklers, all those things wear out and you'll need new ones eventually. So we do depreciate land improvements. Let's look at this example. Smart Touch Learning purchases land on August 1 for $50,000 with a note payable. They've also paid $4,000 in property taxes that the previous owner owed, $2,000 in transfer taxes, $5,000 to remove an old building, and a $1,000 survey fee. So here's the purchase price of the land. Here are all their extra items they had to pay in order to become owner of that land. That they add up to $12,000. So the 50 plus the $12,000 gives us $62,000. Here's what we record. We debit land for $62,000. We credit the note payable for the $50,000, and we credit the cash for the other $12,000 we made. Capitalized is a new definition. Okay, that means we have put a long-term asset on the book and we've charged an amount. We've debited the asset for a certain amount. That means we've capitalized. Okay, just be aware of that terminology. You'll see that throughout. All right. Afterwards, I have the land. Now I pay $20,000 for fences. Well, look at what I'm debiting. Not land, but land improvements. It is a separate account from land. So I debit land improvements and I credit cash. By the end of the year, we will depreciate our land improvements. What other assets? Buildings. Anything I pay to acquire a building. If I have to make renovations, if I'm buying a building and I'm changing it into a hospital, there's filtration systems and special HVAC and special entrances and doorways and ramps that will need to be installed. All those costs will be added into the price of the building itself. Same thing if I'm making a building from scratch, it's being constructed. Anything, all the fees here you see, if I have to develop temporary walkways for people to go around the construction site, all of that, architectural fees, building permits, that all will be charged to the price of the building. How about machinery and equipment? That's another type of fixed asset. So again, your purchase price, transportation charges, insurance, sales tax, installation costs, those are the things I said sometimes you need a specially qualified person, an engineer, technician, to make sure it is hooked up correctly, to make sure your current voltage system can handle the power of the machine, things like that. That last bullet I'd like to bring your attention in your testing costs. Those are the costs that when you plug the machine in, you're like, okay, is this, is this machine going to fill the chocolate mold in the appropriate way? Well, you don't know till you run some batches. That testing of the machine to make sure it's producing in the way you want, the costs associated, the materials, the manpower, all those costs are part of capitalizing the machinery and equipment. All right? Until you find the point where it's perfect, now we can get it up and running. Everything else that you've done, any expenditure you have, incurred in order to get the machine to where you want it to be, is capitalized. Furniture and fixtures, we all know, desks, chairs, cabinets, credenzas, things like that. Okay. I am going to end this video here. We went through some examples of PP&E. Make sure you're familiar with them. And I will see you on the next video.